Hello, everyone. So today in this session, we will be discussing the critical insights that every investor need to know before getting into IPOs. So if you look at IPOs, IPOs are very tempting and it is often seen as a quick way to gain that profit, that initial listing profit that you are getting attracted with. But if you look at the data actually suggests that many investors might not get the returns that they're actually expecting. And let's see all these in this video. And by the end of this video, you will understand whether IPOs should have a place in your investment strategy or not. So let's start by understanding the reality of IPO investing. There is a study which was conducted by SEBI during this time of 2021 to 2023, that 2 years have been taken into consideration. And in that, if you see, 54% of investors actually sold their IPO shares within a week. What does that mean? When you are applying for IPO and 54% of the investors are selling within a week, automatically means that they are trying to get that quick gains of that listing. So that means IPOs are very lucrative, but they don't always lead to massive gains as expected. So this is something which we need to understand, and why IPOs are there. If you understand, then the chances are very less that you will invest in IPO. Okay, so we'll get into the details. See, the reality is that IPOs are primarily designed to maximize the company's valuation. Okay, so at the time of listing. Now, when the private company goes public, now what do you mean by IPOs actually? I started a company and along with maybe my friends, so we hold 100% of the shares. Now, when we are going for listing means we are diluting our share, we are selling our share. So what we are actually doing is we are showing this at the maximum valuation, and then we get maximum profit out of it when we are selling, and nobody want to sell it at discount. So when the IPOs are issued, initial public offer, later there will be follow-on public offer also, but at this point of time the company will be at its maximum valuation, and the original owners, the existing shareholders, the founders of the company, the early investors of the company, they actually seek an exit at this point of time, and they will only prioritize their return. They don't want to sell it at discount. That's the highest price that they are selling. But normally, some of the investors have misunderstood that you will get quick and easy gains in the first week itself, because you have seen such cases, but that's not the case. That's 50-50. Anyway, we will get into the details of it, but understand why company is going for public. First, the reason is liquidity. When a company goes public, it becomes easier for the existing shareholders, the founders, the early investors, that they can sell their share and that they can convert their investment into cash easily. So that's the first reason. Second, if you look at it, could be related to regulatory requirements. In some of the cases, when regulation may require large industry or critical companies to go on public for ensuring transparency and accountability, they may go for public. Then third is the most important one, that is the status and prestige. And for the founders, being a public company founder or CEO of a listed company, that carries a prestige and marks a significant milestone in our life. If you see, this is actually the dream of many of the founders of any company. If you, even if you are starting a new company or any startup, what is the ultimate aim? It need to be listed on one day, and you need to issue IPO, public funding, on one day. This is actually the milestone and the dream of any business person. Okay, now the question is whether IPO will benefit the new investors. Guys, when a company goes public, it often tries to list at the highest valuation possible. As I told you, that's when the original investors, the founders, will get the maximum profit. The founders and the existing shareholders maximize their exit value, and that is their priority. And never they want to give it at a discounted price for you just for getting some public funding. So they want new investors to succeed, of course, but the focus remain on achieve what? Highest listing valuation. So if you are able to list at the highest, then only you will get a better exit, and the maximum profit when you are selling or diluting your share. So it is not necessarily, you will get it at a discounted price. Always think that many have this mistake or misunderstanding that when you apply IPO, when you get a share at IPO, this is the best ever price that you can get. This is a discounted price. No, at that point of time, this is the highest of the price that you are buying. But later, once it comes to the secondary market, after issuing IPO, it is coming to secondary market. And when it is traded, based on supply demand, it may go up or down. I'll talk about different scenarios where this price is going up, giving 20% more returns and even losses also. I'll talk about that scenario. So what does this mean for us? The retail investors entering IPO at peak valuation might not see returns they're actually hoping for. Let's also look at some of the IPO performance data. I take four scenarios. Market is up, IPO is up. Market is down, but IPO is up. That's a rare case. Market is up, IPO is down. If the company is not going good, then that may happen. Market is down, IPO is down. That's the most common case. That also we will discuss. So let's start with the first case where market is up and IPO is also up. So market is going up, you come with IPO. So IPO is also going up. Chances are good. Even if you are an average performing company, the IPO will definitely do good, right? So 30% of IPOs fall in this category, and an average gain, if you see, it's around 20% in the first week. So 30% of such IPOs gave around 20% gain in the first week. When the market was going up, IPO was listed and 30% of the companies. Now, second is market is down, IPOs going up. See here, this will happen that the IPO may outperform the market, maybe due to the company's performance and other things. So those are rare but positive outcome anyway. And 20% of IPOs comes under this category. For example, now market is falling. Suppose an IPO is coming, and if the first week they are winning, means it is outperforming the market, and that is actually a rare scenario, but a very positive scenario. Around 20% of the IPOs comes in this category. But what is the profit? What is the gain? Gain is 5%. In the previous case, market is up, the IPO is also going up. There the gain was 20%. Here market is not favorable, but IPO is outperforming the market, but the gain is moderate, which is 5%. Third is market is up, IPO is down. Still 15% of IPOs comes under this category, which is not at all favorable, because market is going good and this company's IPO, when they're issuing, it is coming down, means the company's viability or the future prospects is not that good. That's what you can understand from that. Now next look at market down. IPO is also down. That's the largest share. If you see, that's around 35% of IPOs that will decline along with market declining. So here the loss average is around 15% in the first week. So I hope this is clear. First category, market up, IPO up around 30%, and the profit is around 20%. Second category, market is down, but IPO is up, which is around 20%, but with a moderate profit of 5%. Third category, market is up and IPO is down, which is again around 15%. Don't get trapped into that 15%. That's the worst situation. And also market is down, IPO is down 35%. So if you look at the last two categories, okay, market is up, IPO is down 15%. Market is down, IPO is also down around 35%. So 50% comes in this category. So can I say it's a 50%, 50-50 chance? I've taken into all possibilities. So it's clearly a 50-50 week, right? Market up, IPO down 15%. Market down, IPO down 35%. So that itself, IPO is down, that is 50%. IPO is up 50%. So your winning chance is 50-50. So many of you are actually not understanding and simply applying for IPO without knowing the fundamentals and other things, which is not really good. Now, the question is IPO investing worth it? See, IPO can be unpredictable, of course. And as I told you, it's a 50-50 possibility in the first week due to factors like, short-term capital gains tax and the difficulty of getting an allocation. Even listing gains might not significantly impact your wealth. So IPO investing should not be seen as a shortcut to success, but as a decision that require a careful consideration, research, and long-term perspective. So if you look at long-term investing in IPO stocks, that can be game-changing. That can be really good. So IPOs may not yield instant return. Some of the cases you have seen recently, but these are exceptions. But long-term investment in the right IPOs, I'm not talking about all IPOs which are coming, you need to apply. You need to go for the fundamentals, you need to conduct the study, and then proper research and everything need to be done, and then select the right IPO and sit with that. So if you see that first study that I've discussed, 54% is selling in the first week itself, means majority comes in that category of trying to get that quick initial listing gains. But that's not the case. Right? Rest of the 46, where are they? It may be for next 1 month. Some will hold for 6 months. Some will hold for 1 year. Some may for 5 years. Some may for lifetime. But that comes in that 46 category, and who will be carrying for lifetime? Maybe 1% or 5%. They will actually make the wealth. But how can you do that? If you have chosen the right one, doing the proper research. If not, this is not going to benefit you. 54% of the population or the investors comes in the first week category, and first week the chances of profit, what I've discussed, is already 50-50. So 54% is trying to get that initial listing gain, and their profit chances 50-50 actually. So but if you do it long term with proper research, with the right IPO, it can be rewarding, and that's what the data shows. The data actually shows, there are stocks with 3 years in the market even often outperform Nifty index also. So that can generate even higher returns for patient investors. For example, IPO stocks that beat that even can beat market average, sometimes offered annual gains of around 25%. So 25% means you can double the capital in 3 years. Okay, so that's something which is very good. So, guys, what I want to tell you is IPOs should be approached very carefully and with realistic expectation, and understand that you cannot go with all the IPOs. The chances are 50-50 of that if you're looking for that initial listing gains, because you are buying it at the highest of the valuation. You have seen what happened with the Ola Electric and other things. Okay, so instead of jumping in at listing, what you can do is you can monitor the company's performance for a few quarters, and if you see consistent growth in the company, and if the company having strong fundamentals and sound management, then investing for long term can lead to substantial returns. So that's something which you can do. So that's about this session, guys, and thank you so much for watching. See you in the next session. Thank you.